Hello and welcome to the latest investment market update. I hope that you're all keeping well. I'm Brian Morman, Chairman of Brunsdon Financial, and today I'm being joined once again by Mark Shields, Investment Director at Brooks Macdonald. Good morning, Mark.
Morning, Brian.
Brooks Macdonald have been carefully selected to manage the Brunsdon investment funds, and using their expertise, the team analyse movements within the market and make tactical changes. Today, we're taking a closer look at the technology sector of the investment world. So, Mark, first question that we get quite often is market performance of late has been dominated by the technology sector. Can you explain why this is the case?
Yeah, I mean, at the moment, at least over the past sort of 2 years or so, the markets, certainly in the US and globally, have been dominated by the performance of a fairly limited number of typically very large technology companies. Some names are Microsoft, Apple, Nvidia being the kind of now, as we speak to you, as of this morning, now the largest company in the world. Given its recent share price movements, Alphabet, Meta, and a few others as well. These companies have all performed exceptionally well, largely due to investors perceiving them either indirectly or directly having a big exposure to the world of AI, artificial intelligence. And this is an area which has the capacity, at least, to significantly enhance productivity, both at a company and also an individual, and also at a country level. And clearly, the ramifications of this are very pronounced, and it is potentially extremely valuable. So those companies that have done well are those that are the most exposed to this AI sub-theme of technology. And probably the best example of that is Nvidia. As I just said, it is now the world's largest company, having overtaken Apple as of this morning, because it makes chips, microchips, that are almost predominantly used, or certainly the leading microchips for the enhanced processing that is required to run generative AI. I believe its share price is up something like 1,000% in the space of less than a year, so or 18 months, I should say. So it really has been that part of the market, that part of technology that has been driving all the returns due to the interest and investor speculation over the world of AI.
And what risks, as such, do you see as an investment manager?
Yeah, I mean, there clearly are risks here. As I just said, a lot of the prices of these companies have moved very aggressively. Now, the expectations of their earnings have also moved up quite significantly as well, as have their delivered earnings as well, for that matter. However, they are still sitting on quite rich premiums, as it were. They are quite expensive companies. These are companies that are no longer cheap. And clearly, if we do see, for whatever reason, if we do see these companies failing to meet what investors expect of them, we could expect their share prices to be quite heavily impacted off the back of that. A very good example of that is Tesla. Up until the beginning of this year, Tesla was performing exceptionally well, had a very high share price, and it was, perceived to be very valuable and very expensive. I believe the Tesla share price this year is down around about 35–40% because it hasn't delivered the number of cars that were expected of it. Its earnings haven't maybe met those lofty expectations that analysts said we should expect from it. And also there's a slight degree of personality issues there with Elon Musk. So my point is that even though these companies are at the moment performing exceptionally well and they are delivering very good outputs for investors, there is the risk that if for whatever reason they don't meet those, their high valuations come back to haunt them and their share prices fall significantly. I'm not saying that's definitely going to happen with the likes of Nvidia or Microsoft or anything along those lines, but it most certainly is a risk that we need to be aware of. And equally, in the world of technology, it is a marathon, not a sprint. You don't always find that those companies that are the sort of first to leave the start the race are necessarily the ones that are going to end up winning the race. And we have to bear in mind that these things can take quite a long time to pan out, and there are clearly some potential issues that we need to be aware of when we're looking at technology as an investment.
Yeah, I remember Amazon. It took ages before Amazon made a profit, and just looking at some of the companies that you just mentioned, you get PE ratios of 60 times, which in essence means you've got to wait 60 years to get your money back on a dividend. But of course, people are working very much on the capital value increasing, aren't they?
Yeah, absolutely. I mean, a lot of the value of the share price is derived from where investors expect those earnings to be at some point in the future, and as to whether you're willing to pay that price for it is up to you, really, to be honest. But at the moment, the market is willing to pay a high price for these companies because the market does believe that ultimately the growth of those companies will justify those expensive share prices. But we've got, again, looking back, the history is littered with certainly in the world of technology, history is littered with companies that have initially been deemed to be the sort of next best things in a certain field and have maybe not sort of seen the distance. Nokia and BlackBerry at the dawn of the smartphone age.
Yeah.
They were first past post. Sun Microsystems, the dawn of the internet age, and even IBM at the dawn of the PC age. All of these companies are definitely not the sort of beasts they were expected to be when these sort of revolutions first started.
Okay, Mark. So taking all that into account and looking at the Brunsdon asset management funds, how do you position technology within the cautious and the adventurous funds?
Yeah, I mean, technology is definitely one of the core themes that we're playing in the portfolios at the moment. We do have dedicated technology exposure in the portfolios, and it is one of the sort of key areas that we feel that can add outperformance to our portfolios. And indeed, our technology assets have been one of the best performing assets in the portfolio, not only this year but last year as well. They've really delivered some very strong returns for our portfolios. We most certainly will continue to hold those positions. We do feel that technology is a part of the market that we want to have exposure to. We do recognize the risks that I've just outlined, but we feel that our diversification by having exposure to other parts of the market as well as technology justifies those dedicated positions in the portfolios as well. So we do have positions in these companies. We want to keep those exposures that we do have, but equally we want to make sure that we're diversified. We don't want to put all of the funds into a technology related exposure, because clearly that would take on a lot of risk. We want to make sure that we've got exposure to other parts of the market as well, especially parts of the market that maybe aren't looking quite so expensive. The UK is a good example of that. So it's all about that diversification, management of risk, but also trying to make sure that we do have exposure to those sort of companies that we like.
Okay, Mark. Well, thank you for those insights and those comments. And I'd like to thank you also for watching. As always, if you have any questions or queries, please be in touch with us. Thank you.